Tonight I will be discussing a series of topics related to the financial war that is going on for your bank account, and we will be discussing the low interest rate, how that's blown a giant credit bubble where banks have created an infinite amount of credit, it seems like, and their cheap money has inflated the stock market and the housing market. We'll discuss the derivatives monster that is sort of inconceivable. I've never experienced or have no historical reference for something that's $1.2 quadrillion in value. And we'll discuss the liquidity trap that our government has drawn our investors, our savers into, and we'll discuss how the recent rise in delinquent payments has caused triggering events for banks to start liquidating their assets and turning their debt into liquidity. And this is a big problem. Finding liquidity is a big problem because the fractional reserve banking system is backfiring, where you thought that it was a benefit to have a whole lot more credit because you could loan out a whole lot more credit. Now you are experiencing, as a bank, a lack of liquidity when all your creditors are expecting to be paid. And this time I don't think that there will be any bailouts from the governments. We'll have to see, but the banks are going to hit the ground most likely, because governments are strapped for cash as it is, and governments, whenever they're strapped for cash and back against the wall, they tend to take us to war. And we've been hearing a lot about Russia and Syria recently, and I'm nervous about Russia and a potential war with Russia, but I believe that is one big diversion, and we'll get into that. So the mega banks have created an enormous amount of credit through the fractional reserve banking system, and all of that credit has to find somebody to lend to. So it's been a fire sale of mortgages and student loans over the last economic boom, the last 7 years. When you have that much credit, you tend to run out of good lenders and average lenders, and eventually you end up dipping into the subprime lenders, which laid the seeds to the subprime crash back in 2008. Basically, all of this makes it very challenging to lend responsibly to and intelligently. And eventually those subprime borrowers stop scraping together their loan payments, and they go delinquent on their loans, and the bank ends up foreclosing and having to sell the house for pennies on the dollar, which is terrible for the housing market. Or to avoid foreclosure, many homeowners just bite the bullet and sell the houses that they can't afford, which also would trigger the housing crash. Central bankers have blown another round of stock and real estate bubbles over the last 7 years using reduced interest rates. The Fed has reduced the baseline interest rate to loosen lending to 0.25% interest, and that provides banks with plenty of interest they need to host the biggest loan sale in American history. When the interest rates are lowered, it's the big purchases that a family makes that are incentivized. It's the house purchase, it's college tuition or a car purchase that end up bubbling. Those are the markets that end up bubbling. But I've even seen furniture and computer financing, during this bubble. There's just such a supply of credit that it needs to find somewhere to lend to, someone to lend to. If you are listening but not watching, now is the time to switch. We are going to do some charts. Here is the S&P index, housing index, on a 40% tear since 2012, so clearly the housing prices have recovered. Now that's great if you own a home, but home ownership is at very low levels, the lowest since the 1960s. The S&P 500, however, experienced a much more distinguished bubble over the past 7 years in comparison to the housing market. The bubble started back in 2009. We're going to take a quick look at how it started. Stocks had bottomed after a devastating 2-year crash and started a rapid reversal just 6 months after the Fed had cranked up the printing press and started offering a 0.25% Fed funds rate. By March of 2009, the stock crash was over and prices were on the rise again. Within just 7 years, the major indices have tripled. Now, over the last 7 years, since 2009, we have not seen a tripling of the American economy. American wages have not tripled in the last 7 years. The stock market is just jumping like this because banks are extremely responsive to interest rates. It's mostly the banks borrowing interest-free money and investing in stocks that triple in value that has caused this stock bubble. And that kind of profit, going from a 0% loan to a tripling in value over 7 years, that kind of profit has drawn a lot of money into the stock market. Last December, the Fed decided it had to raise interest rates a 0.25% to prove that the United States economy could handle it. Well, apparently we couldn't, because the stock market tanked. Within 2 weeks, the Dow embarked on an 11% free fall. All we did was raise our Fed funds rate from a 0.25% to 0.5%, and the NASDAQ lost 16% of its value within a month. I think the markets were nervous the Fed would continue to raise rates like they were talking about. But the Fed has talked about that all year long now, and nobody believes Janet Yellen anymore. They have just wanted to stall the day of reckoning until Obama is out of office and potentially pin this on Trump. Banks lend to each other at a different rate, however, than the Fed funds rate. It's generally connected, but they lend to each other at the interbank interest rate, which is actually connected to market forces, unlike the Fed funds rate. In October, bankers noticed a tightening of the liquidity supply and started to disregard the Fed funds rate and increased their own interbank rate in an attempt to hold on to liquidity. The Fed raising interest rates in December was actually in response to the bank's lack of liquidity and their already increase in the interbank rate. It was an attempt to regain control of the interbank rate, and it actually worked. They were able to halt the interbank rate from rising at just above 0.6 until very recently. Clearly, the banks are nervous again. They're charging each other nearly 0.9% interest now, well above the 0.5% Fed funds rate. Rates are on the way up, with or without the Fed, unless they can queue up another round of quantitative easing. What pricked the housing bubble back in 2007, as seen in The Big Short, was large investors realized the loans were subprime before the markets did, and they short sold them, selling off their mortgage-backed securities and crashing the housing market. The mainstream media, financial news, and Hollywood like to shorten and narrow the scope of their audience's view of the collapse. And just shorten it to the subprime part of the collapse. But what caused the banks to lend to subprime borrowers? Primarily low interest rate liquidity allowed the banks to sell mortgages at such low rates and gives the savers incentive to invest in the stock market rather than invest in a bank or savings account which earns next to 0% interest. So interest rates caused the stock bubble and the housing bubble. All of this apparently happened because Bush tried to help. Bush tried to increase the home ownership rate in America, which is a noble cause. But like most government programs, he accomplished the opposite. The increase in home ownership that we saw during the housing bubble has completely disappeared and since has continued to crash. The derivatives market is kind of the black market for the investment bankers. Derivatives don't have to be kept on the books, which is a huge red flag, and banks are basically given the ability to write whatever contract they want based on whatever derivative asset they please. Here is a chart that Tyler Durden found from Zero Hedge, posted, which shows the 25 largest American lenders and compares their derivatives exposure. And if you notice, the top 6 companies all have exposures 20 to 30 times larger than their total asset value. And even giving them this, even considering the total asset value gives banks a whole lot more credit than they deserve. The stock market gives these companies its own valuation, and that's called market cap, where you take all the stock out there at its current market value, and that is basically your market cap, the value of your company. Deutsche Bank, for instance, the largest German bank, has a market cap of about $18 billion. That is compared to a $64 trillion derivatives exposure, which absolutely dwarfs the entire GDP of all of Europe. When asset prices normalize, most of these banks will take massive losses and risk potential insolvency. Investors and depositors must really be sweating. A slew of Deutsche Bank's hedge fund managers recently liquidated their assets. And maybe they know something that we don't. Powerful investors tend to get warnings when they are just whispers of insolvency. Once the warning bells are ringing, it is often far too late. In fact, it's probably far too late as we speak right now. If you own Deutsche Bank stock, only a third of its value remains from last year. Smart money, or as I like to call it, the nimble money, sees the impending crash and steps out of the way. Well, many people hear the warning bells but can't step out of the way or choose not to, or incentivized or not to step out of the way. Most people, especially retirees, have their assets in less than liquidable assets like 401ks, like IRAs and pension plans. And they were goaded into these plans using the pre-tax income incentive, where you get to invest your pre-tax income. But now the retirees are probably stuck holding on to really overvalued assets, and it's a huge tax to withdraw them early. Liquidity issues really only arise when the bank has to produce actual cash. Fractional reserve banking allows banks to offer $10 of credit for every dollar on reserve. So suppose some vendor at some farmer's market only accepts cash. When you you stop by the bank to withdraw some cash, you withdraw, let's say, $100, and the bank is a reliable and responsible bank, so it slaps $100 in your hand and says, "Thank you, have a pleasant day, Mr. Madden," and you go on your way. But for every $100 that bank allows you to withdraw, that bank must destroy $1,000 in credit, in bank credit. So the bank has to get somebody to pay back their student loan or their mortgage, and they can't re-lend that money out. That money is just, it's been lent out and brought to completion. Since people are constantly making their payments, this isn't really an issue. The bank stays solvent, but if people stop making their payments, not so much with the solvency. Recently, delinquency has plagued the credit market, suggesting Americans can no longer afford their bubbled housing and student loan prices. Why can't Americans afford their housing payments? After all, Obama and Hillary have been congratulating themselves on a successful economic recovery, walking around the country giving themselves pats on the back. But why aren't there high-quality, bread-winning, house-buying, family-starting jobs for college grads? Instead, more than half of four-year graduates are still making payments 10 years after graduation, and less than half of college graduates still make their student loan payments on time. The recent jump in delinquency is causing nervousness about the quality of the loans. Investors are probably thinking something like, I wonder if my bank did its due diligence and made sure that these lenders are of high quality, or if they're just trusting the Moody's rating system again. Well, the rise in delinquencies are also followed by a rise in bank write-offs, where the bank has to cut its losses and no longer pursue loan payments from a delinquent lender. And this can completely destroy a bank's balance sheet. This chart also provides a vague breakdown of the largest American bank's derivatives. Notice the credit swaps exposure is $114 trillion between all 25 banks, which paints a picture reminiscent of 2008 when derivatives or credit swaps brought the entire banking system to its knees, begging the federal government for a bailout. These bankers bet the bank, everything they have, and many times over on these credit default swaps, which started as an insurance against mortgage defaults, but have really over time, over their overusage by banks, turned into this highly speculative asset. These mortgage-backed securities really interconnect the banks on a risk level, allowing them to share counterparty risk. However, when one of these parties defaults, the damages are endemic. If a bank is central as Citibank or Deutsche Bank goes belly up, we could end up seeing a cascade of bankruptcies throughout the entire banking system. The big question is, will the risky lending be forgiven as it was in 2008? Will the bankers be given bailouts? Banks in Italy and Spain have already asked the EU for bailouts. German President Angela Merkel and the EU already denied them, which sets the precedent for the rest of the failing banks of Europe. European banks will likely have to dip into their depositors' accounts for liquidity in the form of bail-ins. Now, Deutsche Bank, Germany's largest bank, is teetering on the verge of a liquidity event, and this is a huge deal for Germans, who are generally cautious people and conscious people, and they've experienced a hyperinflation event within the last century, so they are likely to pull their money, I believe, out of Deutsche Bank, just feeling the German nerves. The same may also happen in America. To save the banks, the Federal Reserve would have to print a whole lot of cash, which would damage the dollar's credibility and purchasing power. For one, I don't think the American taxpayers are going to be too privy towards another round of banker bailouts, while Americans face another financial recession. I think the homeless Occupy Wall Street liberals learned that lesson back in 2008, but only time will tell, so maybe we'll see another bailout. But two, I think China might dump their dollars if we start talking about another bailout and cranking up the printing presses again. If you turn on the TV and watch the mainstream news with your media goggles on, you'll hear something that sounds vaguely like this. Don't worry about your savings account. Watch out for Vladimir Putin. The media suggests Russia is public enemy number one with this hypnotic, repetitive framing of Putin as this KGB mass murderer who's ruling over Russia with an iron fist. This is not reporting. This is pure fear-mongering propaganda designed to get the United States sheeple to accept a violent conflict with Russia. War with Russia would be terrible. It would be deadly, potentially nuclear. TV pundits would probably call it World War III. And they would try to blame Russia for it. There would be some atrocity that occurred that Russia was at fault for and draws us into the conflict. This is just a diversion. This is not the actual collapse. This is not the actual World War III. This is the watch this hand while this hand reaches into your pocketbook and takes all of your savings. So this has been a brief presentation on the impending doom of our economy. If you have comments, please leave them below, and if you enjoyed it, please like this video. We live in exciting times. I'm very curious to see what happens next.